All right, let's unpack this. You've asked us to take a deep dive into the recent Q1 results for JM Smucker. And wow, what a fascinating, complex picture it paints.
It really is.
It's a real-world lesson, isn't it? How a major consumer brand navigates some pretty intense economic headwinds while, still pushing for growth.
Yeah.
Our mission today is really to cut through the noise, explore the different facets of these results, understand not just the numbers, but the strategic thinking behind them.
It's true. There are so many different forces at play here. I mean, on one hand, you see these significant challenges that, frankly, would cripple many companies.
Right.
But then you also see some incredibly impressive strategic maneuvering. Our goal is to give you a clear, comprehensive understanding of what's truly happening beneath the surface and why it matters.
Okay, so our first look at Smucker's Q1. It immediately tells this story of resilience, almost a paradox, really. You'd expect a company facing significant headwinds, quote unquote, to struggle across the board, right? But they actually raised their full-year sales outlook.
Yeah, that's the kicker.
It feels like a contradiction. Is management just, putting a brave face on things?
Right.
Or is there some genuine strategic brilliance here in how they're handling, say, these tariffs?
That's a really fair question, and it gets right to the heart of their current balancing act. You're right, it is a paradox.
Okay.
The company reported a net loss this quarter.
Loss, right.
Yet they managed to raise their full-year sales outlook. Now, the primary headwind, and we'll definitely get into this, is rising coffee tariffs.
Coffee.
Yeah, they're really brewing trouble for profitability. But the underlying story is how they're using, strong pricing power and this undeniable momentum in key growth brands.
Right.
That's how they're counteracting these soaring commodity costs and tariff impacts, all while, continuing to invest for the long term. It really shows how companies have to constantly balance managing immediate costs with strategic long-term investment.
So with that tension clearly in mind, let's get into the nitty-gritty. What do the headline numbers actually show us about this complex quarter? Because, a net loss with higher sales guidance is certainly a head-scratcher.
Well, the figures, they paint a clear, if challenging, picture on the profit front. Smucker posted a fiscal first quarter net loss of nearly $44 million.
Wow.
Yeah, quite a swing from a $185 million profit in the prior year. That results in a net loss of 41 cents per diluted share, which, accounts for all potential shares, giving the most conservative view.
Right, the diluted number.
Exactly. And their adjusted earnings per share, the adjusted EPS, which strips out some one-time items that also came in lower, $1.90. That's a 22% decrease year over year, and it missed analyst expectations.
Missed the street.
Missed the street. Total net sales were $2.11 billion, slightly down 1% from last year, also falling just short of Wall Street's forecast.
Okay, so sales slightly down too.
But here's a crucial point. This hints at their resilience, their comparable net sales.
The organic growth metric.
Exactly. Essentially, growth from their core ongoing business, stripping out noise from acquisitions, divestitures, currency changes, that actually increased a healthy 2%.
Okay, so the core business is growing.
It is. But the cost pressures were very evident. The adjusted gross profit margin declined significantly by 4 percentage points down to 35.2%.
Ouch. 4 points is a lot.
It is. And free cash flow, which is just crucial for liquidity, right? That actually turned negative. $94.9 million negative this quarter compared to a positive $49.2 million last year.
Negative cash flow. Okay, so if I'm hearing you right, that comparable sales growth is, it's a positive sign, but it feels completely overshadowed by this profit contraction and the negative cash flow.
Pretty much, yeah.
Which really brings us to the why. What's truly driving these figures, both the dips and those bright spots? This is where the strategic decisions really come into play.
Absolutely. The biggest drag on profitability this quarter, without a doubt, was the tariff impact.
The coffee tariffs again.
Yes. Tariffs on coffee imports, mainly from Brazil, caused their retail coffee profit to fall by a significant 22%. 22%.
Just from tariffs.
Largely, yeah. In fact, Smucker now anticipates a 50-cent headwind to fiscal year 2026 adjusted EPS from these tariffs. That's up from their previous expectation of 25 cents primarily hitting green coffee costs.
Wow, that's a huge hit to absorb.
Yeah.
$0.50 per share?
It's massive. So, to combat these higher commodity costs, Smucker implemented strategic pricing. They raised coffee prices back in May and then again in August.
Okay, passing it on.
And this is interesting. That contributed a full 6 percentage points to comparable net sales growth.
6 points just from price hikes.
Yeah. And this isn't just a win for Smucker's pricing strategy. It's a fascinating insight into consumer psychology, right?
How so?
Well, it suggests that even in these inflationary times, for a daily staple like coffee, brand loyalty and maybe perceived necessity can override price sensitivity. To a surprising degree, actually.
Huh. So people grumble but still buy their Folgers or Dunkin'.
Seems like it, yeah. It implies there's still significant pricing power in core consumer categories. That's a crucial lesson for other brands facing similar cost pressures.
That's a great insight. So they're raising prices, consumers are mostly sticking with them, which helps the top-line sales. But surely volumes must be taking a hit somewhere.
They are. Yeah, you're right. On the flip side, volume and mix. So how much stuff they're selling and what kind of stuff that decreased comparable net sales by 4 percentage points.
Okay, so price up 6, volume mix down 4, net comp sales up 2. Makes sense.
Exactly. And those declines were driven by coffee brands like Dunkin' and Folgers, also dog snacks, sweet baked goods, fruit spreads. So while price increases are helping, fewer items are actually moving off the shelves in some key categories.
Right.
But it's not all about the headwinds. They have some real star performers that are defying this trend.
Like Uncrustables. I keep hearing about them.
The standout success story is definitely Uncrustables. It continued its strong double-digit growth, attracting new buyers, all demographics, expanding into convenience stores.
It's amazing how that product took off.
It really is. And the Uncrustables story, it's more than just impressive growth. It's almost like a blueprint for recession-proof innovation.
What do you mean?
Well, in this volatile market, this convenient, no-prep product has just carved out a unique niche. It proves that differentiation and ease of use can create totally new demand segments, even for a legacy food company.
Yeah, good point.
It's a masterclass in modernizing a portfolio. And they're on track, they say, to generate over $1 billion in net sales just from Uncrustables by year-end.
$1 billion for frozen sandwiches. Incredible.
Incredible. And Café Bustelo also delivered impressive growth, 36% net sales growth in U.S. retail coffee, fueled by marketing, new innovations.
Okay, another strong performer.
Yeah. And the company also achieved its goal of $100 million in total run rate synergies from its transformation office. That means they've locked in annual savings from things like integrating the Hostess Brands acquisition.
Ah, the Hostess deal. So they're finding savings there.
They are. Strategic actions like reducing the number of Hostess SKUs, product variations by 25%, closing a manufacturing facility, those are expected to deliver significant cost savings going forward.
So they're fighting back.
Absolutely. You really see the company fighting back against challenges with strategic moves like pricing, but also focusing laser-like on these star performers.
Okay, with those overarching drivers in mind, it makes sense now to drill down a bit. Because, as always, not all parts of a giant company move in the same direction, right?
Not at all.
So where exactly are Smucker's wins and losses really showing up in their specific business segments?
Well, what's truly striking here is the stark contrast between segments.
Okay.
In U.S. retail coffee, net sales surged 15% to over $717 million.
15%, mostly price, I assume.
Largely due to those price increases offsetting commodity costs, yes. However, segment profit plummeted, a staggering 22%.
22% drop in profit despite higher sales.
Exactly. And margins contracted a massive 9 percentage points. That's nearly a tenth of their profit margin wiped out in coffee alone,
Right.
directly reflecting the heavy impact of higher commodity costs and those tariffs we talked about.
9 points, that's brutal.
That is.
Ah.
Then you have U.S. retail frozen handheld and spreads. Net sales declined 2% there.
So Uncrustables wasn't enough to offset everything else.
Right. While Uncrustables showed impressive growth, it was offset by decreases in peanut butter and fruit spreads, and also increased marketing spend in that segment. Segment profit there was down 4%.
Okay, what about pets?
U.S. retail pet foods also saw sales fall 8% and segment profit decrease 12%, primarily driven by declining dog snack sales.
Dog snacks down.
Yeah.
And Hostess, sweet baked snacks.
That segment, which includes Hostess, plunged 24% in net sales, and segment profit crashed 54%. 54%.
Wow, so the Hostess integration is still challenging.
Clearly. Efforts are definitely underway to stabilize the Hostess business, and they mentioned some early positive signs are starting to emerge, but yeah, a tough quarter there.
Any bright spots?
Yes. The true bright spot, segment-wise, was international and away from home.
Yeah.
That was a strong performer. Net sales up 7%, and segment profit soared 35%.
35% profit growth. What drove that?
Fueled mainly by double-digit growth in their away-from-home business, think restaurants, cafes, institutions.
Interesting. So selling to businesses is doing well.
Very well. It really shows us, like you said, even within one company, performance can vary wildly between different product categories and markets.
Okay. Beyond the immediate sales and profits, it's always crucial to look at the underlying financial foundation.
Absolutely. The balance sheet.
Yeah. What's happening with Smucker's balance sheet and cash flow, especially after a quarter with negative free cash flow? And with their acquisition strategy, what's their debt situation looking like now?
That's a critical question, especially for investors. Total net debt increased. It's now approximately $7.95 billion as of the end of July 2025.
Almost $8 billion. How much was it before?
It was $7.61 billion just back in April, so up about $340 million in the quarter. Consequently, their net debt to EBITDA ratio, that key measure of leverage.
How many years of earnings to pay off debt, basically?
Right. That now stands at an elevated 4.3 times, up from 3.6x in the prior quarter.
4.3. That's getting up there.
It is. For context, anything usually above 3 times often starts raising eyebrows in the market.
Right.
And as we mentioned, free cash flow turned negative this quarter, negative $94.9 million compared to positive $49.2 million last year, primarily driven by the lower net income, though partially offset because they spent less on capital expenditures.
So less profit, less cash coming in. How are they addressing the debt?
Management was very clear. They reiterated their commitment to prioritize debt reduction. The plan is to pay down $500 million in debt in each of the next 2 fiscal years.
$1 billion over 2 years.
That's the goal, to reach a leverage ratio of approximately 3.00 times by the end of fiscal year 2027.
Back down to that 3x level.
Exactly. So connecting this to the bigger picture, it really highlights how large acquisitions like Hostess, combined with challenging quarters, can impact a company's financial structure. But it also shows they have clear plans to address it. The market, though, will be watching that 3.0x target very closely.
Okay, so leadership has a plan to tackle the debt. But looking further out, what does Smucker's management actually say about the road ahead? What are they expecting now, and what keeps them up at night in this dynamic environment?
Well, despite the challenging Q1 profit numbers, they've actually raised their full-year sales growth guidance.
Raised it after that quarter.
Raised it to between 3% and 5% growth for the full year, up from their previous forecast of 2-4%. Comparable net sales are now expected to increase approximately 5.5% at the midpoint.
Okay, confident on the sales front. What about profits?
This is what's fascinating. They reaffirmed their full-year adjusted EPS guidance. Kept it the same. $8.50 to $9.50 per share.
Reaffirmed, not raised.
Correct. And crucially, that's despite that increased tariff headwind we talked about, that extra 25 cents.
So the higher sales are expected to basically cancel out the extra tariff paying.
That seems to be the implication, yes. That the benefits from higher net sales, particularly from pricing, are expected to largely offset that tariff impact over the full year. They also raised their free cash flow projection by $100 million to $975 million.
Raised cash flow guidance despite the negative Q1.
How? Primarily due to tax benefits. Things related to accelerated research and development deductions and bonus depreciation, which lets companies deduct more asset costs up front.
Tax timing benefits. Got it.
But that increased tariff impact on green coffee costs. That remains a significant and growing risk. Now projected, remember, at a 50-cent headwind to EPS for fiscal year 2026.
Still a big cloud hanging over them.
A big cloud. The company says it's actively pursuing alternative sourcing, supply chain optimization to mitigate this, but it's a tough fight.
What about the next quarter, Q2?
For Q2 specifically, they anticipate low single-digit net sales growth and mid-single-digit comparable net sales growth. So still growing the top line. But adjusted EPS is expected to decline approximately 25% in Q2.
Decline 25%. Why so steep?
Mainly due to lower adjusted gross profit in coffee, those tariffs hitting hard, and also increased marketing investments. Management expects EPS to improve sequentially throughout the fiscal year, meaning Q2 should be the toughest quarter, profit-wise.
So a dip in Q2, then hopefully recovery.
That's the plan, and they clearly acknowledge it's a dynamic external environment. Tariffs, regulations, ongoing input inflation, shifts in consumer behavior. They know it's choppy waters.
It really shows a company confident in its sales strategy, but, realistic about the profit pressures in the broader economy.
Exactly.
Okay, so with all these moving parts, the coffee tariffs hammering profits, Uncrustables soaring, the debt plans, stabilizing Hostess. What does this all mean for the big picture? How are industry experts, the analysts, interpreting this whole complex story?
Well, the consensus among analysts seems to be that Smucker definitely demonstrated strong pricing power, particularly in coffee. And that's what enabled them to raise the sales outlook.
Right, the price hike stuck.
They did. However, those tariffs and commodity costs remain significant and actually increasing headwinds to profitability and margins. And that's precisely why their adjusted EPS guidance was only reaffirmed rather than raised, despite the better sales outlook.
Makes sense. Profit pressure holds back the EPS raise.
Exactly. Analysts also point to the robust performance of Uncrustables and Café Bustelo as clear validation of their strategic focus on key growth platforms. The investments in marketing and innovation there are clearly paying off.
The bright spots are genuinely bright.
They really are. On the other hand, that shift to negative free cash flow in Q1 and the elevated leverage ratio, that 4.3x, those are definitely points of concern. They need close monitoring, even with management's clear debt reduction strategy.
So keep an eye on the cash and the debt.
Definitely. Analysts also expect continued volatility in adjusted EPS, particularly in Q2, because of those coffee costs and the planned marketing spend increase. The company is essentially betting on sequential improvement throughout the rest of the fiscal year and then a stronger fiscal year, 2027.
Playing the longer game.
Seems like it. Overall, it's really a story of strategic maneuverability in a tough market. You have key brands defying the challenges, but tariffs acting as a major profit killer, as some might put it.
What a fascinating deep dive into Smucker's Q1 results. It really highlights how a major brand can be facing these intense headwinds on one front, like the coffee tariffs, right? But still find ways to innovate, leverage pricing power, and grow in other areas. It's really a testament to strategic focus, even when the market is anything but calm. So what does this all mean for you listening? It's, I think, a powerful reminder that headline numbers often hide these really complex stories. Stories of resilience, strategic bets, and the constant dance companies play between managing soaring costs and meeting consumer demand.
Yeah, and this raises, I think, an important question. How do companies balance those immediate financial pressures, like falling profits, with the long-term strategic investments needed in growth brands? It's a continuous challenge, isn't it? And Smucker's Q1 offers just a vivid illustration of that balancing act. It suggests that sometimes, maybe, you have to take a hit on short-term profits to protect that long-term growth potential.
A really interesting point to ponder. And a quick but important note before we wrap up. We are not certified financial advisors, and this content is only for educational purposes.
That's right.
If you are considering making any investment decisions based on this or anything else, please consult a certified financial advisor.